Welcome to the first lesson of my new risk management course, Introduction to Risk Management. Most of us are here in hopes of becoming profitable traders or investors, and risk management is an essential part of this, more important than my previous technical analysis course. Let's go over the content for today's lesson. I'm going to start by talking about how to actually make money in the markets, because it's not as simple as people think. Then, specifically why risk management is essential to your success and why you all need to care about it. Then we're going to go on and talk about how to make the absolute most of this course. And then to get into something a little more tangible, we're going to talk about understanding probability in the context of trading and the different types of risk we encounter in the market. Before we start the lesson, here are some disclaimers. Let's begin with the reason most of us are here. How do we make money in the markets? Well, to make money in the markets, you require a trading system. In my previous technical analysis course, I split the trading system into 4 separate components. For the purposes of this course, I'll be splitting it into 3 different components, simply because it melds better with the concepts we'll be sharing in this course, and the end results ends up being exactly the same. So the first part of a trading system is technical analysis. Now, this is what we covered in our previous free course. If you haven't seen that yet, make sure to check it out. You do not need to have done that course to do this course, but it's a great complement. What technical analysis does is it gives you the ability to form hypotheses on which to base your trading decisions. This means you get some indication as to what the market's going to do next based on a specific form of analysis that uses price data. Now, once you get technical analysis down, covered, and you start getting consistent analysis on your charts, you get a good feel for what coins are going to do next, most people think they're ready to trade, when in fact this could not be further from the truth. Technical analysis, or any means of which you can predict what the market's going to do next, is just the beginning. Psychology is arguably the most important part of any trading system, because the trading system is a vehicle and the psychology is the driver itself. No matter how fast your vehicle is, no matter how expensive and incredible it is, if you don't have a driver to drive it, it's entirely useless. And that's the same principle when it comes to psychology. You need someone with the mental framework to execute the trades. And not just for a year or 2 years. If you want to truly make this a career as a trader or an investor, you need to have systems in place to prevent you from making stupid mistakes. 10 years of gains can be wiped out with one emotional, stupid moment after, say, a tragic life event like a divorce, someone dying, getting an extreme illness. Anything can happen unexpected that can mess up your mental framework, and that's why psychology is the most important part of any trading system. And the last component is risk management. So why should you care about risk management? If you take a look at the graph next to me, you'll see the correlation between gains and losses. And you'll notice that they're not the same. Losing 5% of your portfolio does not then mean you need to make back 5% to get to break even. In fact, when you lose 5%, you need to make 5.3% back. Now, this increases exponentially the more you lose. So at 50%, if you manage to lose 50% of your trading portfolio, you actually need to make back 100%. So even if you have a trading system where after you lose 50%, you make back 75%, most people think they're good. They're going to make money off of that. But that is not, in fact, profitable. Now, this can be stretched even further in the example of losing 90% of your portfolio. And this is more than possible. I've unfortunately had horrible DMs from people who have lost 7 figures and are now trading with 4 figures simply because they had no understanding of risk management and how to hold on to their gains. Money that comes easily goes easily. The reason for this is if you make a lot of money very quickly, you likely weren't managing your risk very well. And this is okay, and it can last a little while, but all it takes is one bad event and you take that 90% loss, and then there's no way of getting back to where you were before, because the market doesn't care how much money you had before. Taking a $100 portfolio, to $1,000 is the same as going from $1,000 to $100 and back to $1,000. Most people think because they used to have a certain amount, the market cares for some reason. You'll never be able to make back gains. You can just make new gains based off of the money you have now. Now let's go over some specifics. In the market, there are no absolutes, and this is a fundamental thing with trading. There are no absolute predictions. There are no oracles. There is no way to be certain what's going to happen next. And once I explain probability a bit more later in this lesson, you'll understand better what I mean by that. Your risk management is more important than any specific strategy you use. We explained earlier, no matter how good your technical analysis is, without risk management, you are guaranteed that's an absolute, probably the only absolute I can give you, that without risk management, if you stay in the market, you are guaranteed to eventually lose everything. The next point is that we limit how much the market can take from us. If we go into the market with a 100k portfolio, we don't really want to lose that entire 100k. We need to put a limit on how much the market can take from us and calculate our risk. Finally, risk is a bit of an art. How much money you make is actually dependent on how much you are willing to risk. If you risk too much, as we've said numerous times, you're probably going to lose everything. But also, you can't risk too little, because if you risk too little, you're never going to make any meaningful gains. And there's a subtle art to finding that sweet spot between risking too much and too little, which hopefully by the end of this course, once I've given you a fundamental understanding of the mathematics behind these risk management concepts, you'll be able to apply yourselves. Now let's begin by truly understanding probability. I'm going to use these dice over here to explain why there are no absolutes in the market and exactly how we can, with a game of dice, show that risk management is absolutely necessary. Every time a new candle is printed on a chart, a dice is rolled. Every time we take a trade, a dice is rolled. Now, why are dice so useful in this example? Well, it's because they represent the fundamental uncertainty that comes with trading, the fundamental uncertainty that is so often overlooked.
Now in our first dice game example of this series, our trader has a portfolio worth $5,000. Relative to his net worth, this is quite large, so emotionally this is difficult for him to trade. On top of that, he has no idea how to use risk management and he's using a lot of leverage as well. All this put together means he also is taking on an extreme amount of risk. With every trade he takes, he can actually make a lot of money. If he rolls, say, a 1, he can make $5,000. If he rolls a 2 or a 3, he will make $10,000. But if he rolls a 4, 5, or 6, then he's going to get entirely liquidated. Now that the scene is set, we're going to use these die to replicate this trader in real life.
Now, our trader rolls the dice and he gets a 2. So he's now made $10,000 on his initial $5,000 portfolio. He now has $15,000 and he's able to go buy himself a second-hand Mercedes. Our trader rolls the dice again, and this time he gets a 3. With this 3, he's made another $10,000 and now he has $25,000. He can go buy himself a very nice Rolex. Now the trader at this point thinks that he is a genius and that he knows how to play the market. He has a system and an edge that does really well, and you know what? He may have one as well. But our trader won't stop until he gets himself his Lamborghini. So he rolls the dice again, and this time he lands on that 6. The trade he took went under. There was an event in the market that caused a sharp crash, and due to his high leverage, he got liquidated. See, no matter how much money we make, if our downside isn't controlled, the market can always handle more. It's got an infinite supply of money, but our bankroll is limited, so we will eventually lose everything. Now, if you never watch another video of mine again, if you don't watch the rest of this course, the one thing I absolutely want you to take away from this is that trading is like rolling a dice. There are no absolutes in the market and anything can happen at any time. We're going to continue using this dice example to explain how, unless we completely remove liquidation as a possibility, we'll never be able to trade long term. And even in instances where we've removed liquidation and a system looks profitable, there are still other variables at play that may result in us losing everything we have. Now, the next topic I want to cover is alpha versus beta. This will help you understand the different types of risk in the market so you know what risk is more self-induced and what risk comes out of your control. These concepts can be a little bit tricky, so I've included some very simple explanations to give you an understanding of the concept before diving into the minutiae. Let's start with beta.
The simple explanation of beta is the risk you take on if you just buy and hold. So you're doing no trading whatsoever, you just buy this asset and you hold on to it. Beta is the risk you induce through doing that. Now, the more technical explanation, beta is the asset's risk relative to an index benchmark. And what this means is, take the stock market for example. The stock market over the past, say, 150 years is expected to perform around 8% a year. That 8% is the index benchmark. Let's try to put this into an example. The asset you are trading has a benchmark of 1.2. The index moves 10%. So how much do we expect this asset to move if it has a beta of 1.2 and the index moves 10%? If you think you can figure this out yourselves, feel free to have a try now. To calculate this, what we had to have done is multiply 1.2 by that 10%, which equals 12%. So if the index moves up 10%, then we expect our asset to move up 12%. And the opposite is also true. If the index moves down 10%, then we also expect our asset to move down 12%. You can see earlier we showed how losses matter a lot more than gains, especially when you take them at a 1-to-1 ratio, so you can see the disadvantages of assets with high beta. Next, we have what traders care about the most, and this is alpha. Simply put, alpha is your edge in the market. That's the simple explanation. Now, the more technical explanation is that alpha measures your performance relative to beta. And that relative part is extremely important because it puts your profitability into context. Like before, we're going to put this into an example. Our asset has a beta of 1.2 and the market moves 10%. So remember, our asset is expected to move 12%. Us traders aren't just buying and holding, we're actively trading, hence the name. So as we trade this asset, we try to outperform. Now take an example where we managed to make 20% during this move. That 20% is due to our alpha. So now we get to put our alpha into context. We can see that 20% minus 12% is 8%. So we've managed to make 8% on top of the market, and that is our edge as a trader.
Now we draw towards the ends of this first lesson. Let's talk about how to make the absolute most of this course. I believe in being deliberate with our actions. Let's start by setting the end goal. By the end of this course, we are aiming to fully understand the risk management principles and tools that I provide in this course. Now, if we're beginner traders, they'll be completely new, so we need to learn them. If we're intermediate or advanced, we'll either pick up some new tips and tricks which we didn't know before, or we will reinforce these essential concepts.
To do this, you can do a few things. To begin with, take notes on what you learn. Don't just listen and hope you remember. Actively write down what you plan on applying yourself, what concepts you like and don't like, and then the second tip would be to actually immerse yourself in trading as you're trying to learn this. So you can graduate from memorization to understanding. Make sure you actively apply what you learn. If you're already trading, start using these concepts to improve your trading. And if you haven't begun yet, just use them in paper trading, whatever it takes to actually be using them. Finally, guys, we've built a community over here. We've got a real crypto trading family. If you have any questions, feel free to leave them in the comments below and I'll make sure to get back to them whenever I can find time. I also have a Twitter at Koroush AK. You can find the link in the description below. You can follow me there. I'm always interacting and talking with my followers. I've also got the Market Meditations podcast where you can listen to incredible traders and learn from them, their mindsets, their strategies, their secrets. All of this just adds to your immersion, and there's even the newsletter as well.
Finally, we'll end with a little sneak peek as to what's to come in the coming weeks. Next week, we are going to go over stop losses. It's a complete guide. I'm going to tell you the pros and cons of every single type of stop loss you can use and how to apply them. Week 3, we are going to go over risk and position sizing, an essential complement to every single risk management tool we're going to use. And finally, we are going to end with some more advanced concepts as we explore expectancy, risk to reward ratios, variance, and some more mathematically complex tools that can really help the more intermediate and advanced traders and give something challenging to the beginners. Thank you so much for tuning in to the first lesson of our risk management course. I really look forward to seeing you in the next lesson. Make sure to check out all my other courses, my educational content. It'll help you a lot. All the links are down in the description below. I can't wait to see you next time.